going, and then I'm gonna send out the recording anyway afterwards. So worst case scenario, whoever comes in late, will get the full recording anyway.
Great.
All right, guys. Thank you guys for tuning in. I know this is a little bit earlier than we usually do. We usually do around 7 p.m. Today, we are talking with Jeremy, Jeremy's Pacific time, so I thought we'd accommodate him at his preferred time. We're going to be talking about a topic that I think a lot of people show a lot of interest in, but have a lot of hesitation before actually ever investing in ATM funds. There's a plethora of reasons of why that is, and Jeremy's going to get into some of those during the actual presentation. For anybody who's not familiar with Jeremy Roll, I don't want to do him the disservice of introducing him because his background and his resume is so vast. But I will say, when I first got started, I reached out to Jeremy, and every time I connected with Jeremy, he took so much time to go over the calls in such detail, where he didn't care if I was a novice when I was starting out. He treated me as if I was a CEO of a company. And I never ever forgot that. And every time I would get an email from Jeremy, and Jeremy's emails are quite extensive, I would take my time to actually read them, get back to Jeremy, and then Jeremy would always get back to me. I was always amazed with someone with his reputation of how responsive he was. So when the time came for me to write my book on and picking these different alternative asset classes, a lot of times I pick the asset based on the quality of the speaker I can actually get. And then I was actually having these initial conversations with Jeremy. And the funny part is, Jeremy could have probably done the Q&A on any chapter in my book, because he's basically invested in every single one of those asset classes. We chose ATM because I genuinely felt that he had the best background of actually doing the due diligence on ATM funds. So I was honored when he did my book. I got really great responses from Jeremy's Q&A. Every time I talk to another investor and Jeremy's name comes up, it only comes up in the highest esteem. So without further ado, I thank Jeremy for taking his time. And Jeremy, I will let you introduce this topic that I know you're passionate about.
Okay, Dennis. Well, thank you for having me here. I really hope that this is just helpful for everyone who attended. Anyone who's joining live, thank you. If you're watching this non-live, thank you as well. Dennis, that was by far one of the nicest introductions I've ever had. So thank you. That was very nice. We're talking about ATM funds today, and a couple of very important things just to start, which is, sorry, I'm just trying to, it's interesting. I'm trying to advance this and it's not working. I've never shared a screen before. Is there some special way to advance, or is it just the arrows?
You might just scroll down because you're on the PDF reader. So if you scroll down, does it go to the next page?
Oh, okay. Interesting.
There you go.
All right, I'm going to try that. Okay, thank you. So very important before we start. I'm not a financial advisor, investment advisor, accountant, or attorney. I'm just a full-time passive cash flow investor. I'm actually not an ATM operator. I've never operated ATMs. I've never owned or actively owned ATMs. I've invested passively in ATMs since 2008. So anything I'm sharing today is both my perspective as an investor, is not to be taken as financial advice, and is not from the perspective as an operator, right? So I'm not here to sell you anything, but I also want to make clear that I've never been on the business end of operating these. I've learned a lot by investing in them for 14 years and doing due diligence across a number of operators. But I just want to be clear, this is just from a passive investor's perspective. All right, so what is an ATM machine? So for those of you who are not familiar, I'm sure probably everybody in the call knows what a machine is, but some of you may not know that when you go to Bank of America or Chase and you go to the branch and you withdraw money, that's a proper Bank of America or Chase ATM. It's owned by the bank. It's typically managed by the bank. And the cash in there is the bank's cash itself. But there's a lot of locations in the US, like mom and pop liquor shops, then so-and-so nail salon, barber shop, and I can go on and on, that have non-branded ATMs, meaning they're not a B of A machine, they're not a Chase machine. They're typically a very small branding of a private company on there. And so that's a type of ATM machine we're talking about today. As some of these bullets mentioned, obviously they allow you to complete a wide range of banking transactions, transfers, withdrawals, paying bills, etc. They become much more popular in the past 10 years as companies have gone from having employees to automating a lot of their systems Obviously much cheaper for anyone to run an ATM versus have a full-time employee to dispense cash. ATMs usually operate 24/7, 365. This is true in some cases. There are some outdoor ATMs you may find on the streets of Manhattan at 2 in the morning that just have a very specific special case to them, so no one's going to be able to steal them, and then you can use them. Some of them are in the wall of a building you can use. Some of them are in stores, whether it's in a 7-Eleven that's open 24/7, but some of them are in stores that actually do close at certain hours. The ATMs themselves are up the whole time, though it can be used technically if you get access to it. And the way the business model works roughly is that when you use the ATM and say you withdraw X amount of dollars, there is a surcharge that is charged either to the customer, or if not the customer, sometimes the bank or the credit union the customer is associated with will pay for the fee within a certain network at any machine, for example. So either way, the ATM operator is getting a transaction fee, a fee per transaction, and that's actually their source of revenue. And obviously the transaction numbers add up. Higher volume areas are just going to make more money. It's directly proportional. Okay. There's a secondary fee that they may call interchange. I'm not going to get into that too much today. It's a tiny fraction of what the typical surcharge fee is. I'm talking about it's maybe 3% of the actual surcharge fee. It's a secondary fee that has to do with the processing of the actual transaction. I'm just to not overcomplicate it. We're just going to focus on the surcharge today. So these two key data points, cash in circulation and percent of the unbanked population, both refer to what you want to watch when you're trying to figure out what's going on with ATMs. Are people still using them today? Are they going to use them in the future, right? And who exactly is using an ATM just to begin with, right? So let's talk about cash in circulation today. Unfortunately, I don't have a chart here, but if you can actually go on to the government's website in the US and you can see the cash in circulation. There's a chart that they actually monitor it. And what you'll notice, and keep in mind, this is very different than money printing or anything that we've all talked about recently as investors, right? Because that type of money printing can go to various places, including banks, right? That either lend it, don't lend it, but it's not physical cash in circulation, right? We're talking about actual hard cash in circulation. You can get that data, and a lot of people probably assume that the cash in circulation declines over time, just slowly, right? I think it's a normal preconception that a lot of people have. Frankly, I would think that too. What's really fascinating is that if you actually look at the chart, you'll see the cash in circulation goes up a little each year. And I think that it's going, I'm not saying there's a perfect correlation, but it's going kind of proportionally to the fact that the population grows over time. So while a lot of people may look at, all technology today and say, okay, there's Zelle, there's Venmo, there's PayPal, all these other things have come up over time. In reality, what's surprising and continues to be surprising is cash in circulation continues to go up over time, meaning the cash used in circulation is going up. And so that's something to watch, because if the cash in circulation starts to go down, that basically implies that there are less people using cash, and therefore the ATMs may be having less transaction volume because there's less cash in circulation. Number two is percent of the unbanked or underbanked population. And so when you look at the typical clientele of a private ATM, not the B of A ATMs, but the private ones we're talking about, a very high percent of the transactions either go towards the unbanked or the underbanked. And I'll explain what both of those are in a second. I believe at the moment in the US, depending on what statistics you look at, 18 to 20% of the population falls within these two categories combined. And so I can tell you right now, I hate paying fees. I have not gone to a non-B of A machine I don't remember the last time I think I used a private machine once, and I was like, really bothered by the surcharge, just the idea of it, right? So I am not the target audience, right? The target audience is someone who either doesn't have a bank account and essentially is able to, or has a bank account that's very expensive for them and they can't really afford very much, and they're not taking money out very often. They may be, the one that doesn't have a bank account is someone who, example, gets a gift card as a debit card that they can use to pull cash out of the machine. The most common use of it is food stamps. Those are actually currently provided by the government as debit cards. You can go to an ATM, withdraw a certain amount of cash from it, et cetera. So there's a certain percentage of the people who do not have bank accounts and yet use the ATMs to be able to actually access cash versus going to a branch. And remember, they can't go to a branch because they don't have a bank account. And then there's a certain percentage of what is called the underbanked population who has a bank account probably because they need to, but they don't like using the account. They almost don't trust the system. They may be immigrants that are new here who are not trusting the system. And they're using the machine very infrequently. and very inefficiently, meaning they're paying a fee to withdraw $20 here, $20 there, and it's adding up, but that's just the way that they use the machine. Or they're using it, again, for the same reason we talked about before, through debit cards and other items that they're using to withdraw the cash. So I think a lot of people don't realize how big a percentage of the population that is, right? It's unfortunately the way the US has gone. And I'm actually originally from Montreal, Canada. I live half my life there, and I've been half my life here in the US. So unfortunately, in this country, what's happened is that the percentage of people who are having economic challenges or don't have a lot of very much money saved up and are kind of like the divide between the upper class and the lower class is getting worse, as we all know. And so there's a very large percentage of the population that falls into one of these two categories, even though most of us, or any of us on the Zoom here, cannot relate to it. And so that's who your typical user is. Due diligence workflow. And this actually applies to pretty much any opportunity, whether if you're a passive investor looking to invest in a syndication, which is where they're pulling a lot of investors together, just like, that's what I invest in. This applies to any type of opportunity, which includes ATM opportunities that are out there, right? So obviously for the investment documents, the operator should provide all the proper investment documents to you. Now, I'm not an attorney, but I'm going to tell you what I normally receive, right? So what I would consider to be the normal documents I'd be looking for, which is an operating agreement, which typically it's a legal document that dictates the rules of what you're investing in. And that's very important to review, even though it's a very legal document. So you understand what the rules are for the manager and the operator and what the rules are for you as well, right? Including cash calls and all kinds of reporting and all kinds of important stuff. You have the PPM, or the private placement memorandum, which is what I consider to be a legal document that is somewhat of a requirement by the SEC. Almost all the operators use it. And I think the two main purposes of that document is if you have an unregistered issuance of these securities, when your people are syndicating something, you have disclosure of fees and you have disclosure of risks. There's typically also a business plan that's included. But I think from a legal perspective, disclosures of fees and disclosures of risks are two of the most important things in that document, so that the attorneys that are hired by the managers are kind of providing the correct disclosures to investors. And then you're going to have a subscription agreement, so you can actually move forward subscribing to the opportunity. And you're typically going to have some type of business plan or overview. Now that business plan or overview, A, could be part of the PPM or could be separated. B, can be very short or very long or medium. It's completely up to the operator, right? And so you have to decide, looking at an opportunity, whether or not that's enough detail for you to get comfortable with, to be able to consider the opportunity or not, because that's what's being distributed by the operator, and each operator is completely different, right? Those are the key documents you're going to be looking for. Background checks. So just a quick mention about background checks. I, as a rule, 100% of the time, always do background checks on the operators I'm investing with. And what I target personally, and I'm just one person's opinion, so someone else may do it differently, is I tend to do background checks on all the managers of the manager entity that's managing the LLC, right, that's associated with that operating agreement. And so a couple things about background checks. I have actually been saved by background checks several times. I remember there was one deal very specifically where this investor appeared to have been like going to living in one state, and then he'd do some shenanigans, to put it nicely, and then he'd basically have like 40 people suing him. I'm not even joking. And then he'd move to another state and rinse and repeat. Then another 40 people sue him in another state, right? So I didn't even bother looking at like what it was all for, because you just kind of look at that and say, okay, on to the next. Like, I'm not even going to try to piece this together. There's no point, right? Just too high risk, right? So background checks are very, very important. There's two services that I can tell you that I'm familiar with that are kind of some of the larger ones. One of them, the one that I use, I've been using for years, is called TLO, like Tom, Larry, Officer. It's owned by TransUnion. It's actually in fact, I happen to know a police lieutenant, friend of the family here in Los Angeles. When I told him I was using TLO, the first thing he says to me is, that's actually the first thing we use before we even check our own database when we book someone and bring them into the station. That's how thorough it is. So it's a really great source. The other one that's very similar I'm aware of is called Accurint, ACCURINT.com. That is actually owned by LexisNexis, a very big data company that's been around for decades. Both of these services are very hard to access and actually join if you're able to do so, though, and they're expensive. It's a minimum. I pay a minimum $50 a month for TLO, whether or not I use it. But I think that's like grandfathered rate from a long time ago. I think it's more expensive now. But when you're thinking about investing $50,000, $25,000, $100,000, paying a very small fraction of it for that peace of mind is very important. So that's something I always tell people. I do it mandatorily. Unfortunately, almost all the other investors I know don't do them, and I just hate hearing that, but that's the reality. So I always recommend them. Trust but verify. So let's talk about this in a little bit of detail for ATM specifically. If you get off this webinar when we're done and you Google ATM Ponzi scheme, you will find many Ponzi schemes. This asset class has a lot of Ponzi schemes, and the reason that at least the reason I believe it occurs is because typically you're investing in a pool of many assets. And when there's a pool of many assets that are hard to track, hard to originally verify, and can change and turn over time, that has an increased chance, from what I've seen in my 20 years of passive investing, of having a Ponzi scheme. So this isn't just about ATMs. Note funds that have a lot of different notes that turn around or sold by. Any fund that has a lot of large assets that can have a lot of large turnover is easier to become a Ponzi scheme, for example, than if you're buying one apartment building, right? So it's very important to do as much due diligence as possible on the ATM asset class. I can tell you that I first invested in ATMs as an operator here in Los Angeles in 2008. I then started to try to find other operators over time because I loved the asset class. I successfully identified 3 Ponzi schemes during that time that were not Ponzi schemes at the time, but got broken up by the government, all 3 of them over time. One of which is actually here in Los Angeles, hundreds of millions of dollars, one of the biggest Ponzi schemes ever in Southern California. And when I saw it, it was 2009. It had already been going for about 10 years. And it literally took until 2017 till it got broken up. I did not report it because I was afraid to report it, but because of the size of it. But I thought I kind of identified certain things in all these. So I'll tell you the quick story about the Southern California one in terms of what happened, where I was like, okay, this seems like a Ponzi scheme. And of course, you can never know for sure. But someone sent it to me who I believe was getting some type of referral fee or commission when somebody would invest. And that's not necessarily a sign of a Ponzi scheme. So they were just motivated to have someone invest. And they had already been investing in it for a few years. And I looked at it and I said, okay, let me talk directly to the operator. So I call the operator who coincidentally and thankfully for me is literally 15 miles away from where I live. Okay, it could have been anywhere in the US. They're 15 miles away. They're here in the Valley in Los Angeles. I'm like near Santa Monica. And so I speak to the operator and I say to them, listen, I got an overview, like an email with some information from this person. Can you send me your full business plan? And they say, no, we've been operating for so long. We have investors like just lining up at our door. I mean, they're literally saying these things to me, that we haven't updated our business plan because we haven't needed it for a long time. So we don't really have one to give you. Okay, so no business plan, right? Then I said, okay, well, can you give me your operating agreement? Because if I'm going to consider this, let me at least look at the rules that you're operating under for your LLC. And they said, well, we don't hand out an operating agreement until someone is ready to invest. And I said, okay, maybe confidentiality. That's still a little strange, though, I have to say. But okay, that's not like the biggest red flag, but it's certainly a yellow flag. So one thing I knew about ATMs is that there's 2 or 3 very large processing companies in the US that operators can go through that process and clear the transactions. So imagine like I take money out at the ATM, they're the company that verifies that I have the actual balance with B of A, and then they actually clear the transaction, like the money flow from B of A to this operator, right? They're the intermediary. So luckily for me, one of them called Columbus Data, one of the top 3, I was very familiar with because I had already been investing with the other operator for a couple of years at that point. And I actually had a login. My operator gave me a login to my own ATM. So I was able to look at all the real-time transactions. Literally, if I wanted to sit in front of the screen all day, I'd see when a new transaction came up, okay? It's totally transparent. I said to the person, okay, well, can I come to your office? So I said, sorry, what do you use to clear a transaction? I said, Columbus Data. I said, well, can I get a login so I can see some of your sample machines? They said, well, okay, we don't give a login. Now that's actually normal. Normally you cannot get a login because I was actually investing in individual machines with that other operator, but with larger funds, you normally cannot get a login. So I said, okay, can I come to your office and meet with you in person and see your machines on your terminal? Like show me your list and show me, you don't want to give me a login. Let's log in on your computer that you log into all day long for this business and let me see all your machines. And they said, no, we don't do that. So if I can't drive 15 miles and look at the person's machine on his screen, what is going on, right? Because this is like the operator who has access to all their machines anytime. So I just stopped and said, okay, that's very strange. You know, on to the next thing. This appears to be a Ponzi scheme. So fast forward 4 years later, in 2013, I'm at a hockey game with another operator, actually, and I invested with the student housing operator. And I'm sitting there with him and his partner, and I say, you guys ever heard of this? I think it's a Ponzi scheme. And they turn to me and they laugh and they say, oh, it's definitely a Ponzi scheme. You know, one of them is that I've been investing in it since 2002. I have a lot of friends in it. It's definitely a Ponzi scheme, but we don't care because we keep getting our return, right? We're getting their money. So it was actually became quite well known that it was a Ponzi scheme over time. But in any event, all this to say that if you look at the steps that I did and how detailed I was trying to be, that's kind of what gave it up, right? If somebody just looks at a summary, their friend is invested, and it sounds good and they move forward, that's how you get caught up in a Ponzi scheme in ATMs. But if you do the proper due diligence, you can really reduce your risk. You can never get it to zero, but that's why the due diligence is so important. Okay, I could keep talking about that. I'm going to move on in the interest of time. We're going to get to Q&A after in case people have more questions about that. So I covered the terminal log, right? So you can actually go and see the real-time transactions. Any large operator, if you go into their office, they're going to have access to all their machines. I actually am invested with an operator now with 10 or 15,000 machines. And when I went there and checked them a few years ago, it was 9,900 machines, and they were all there because they all have access to them because they're managing them all themselves, right? So of course they're going to have access. And so that's a very important piece of the due diligence. Now, one thing that's a little unusual in the industry is if you get lucky, you can find someone called an IAD or an ISO. Now, if you think about real estate, which I'm sure a lot of people on the call are familiar with, if you're buying a piece of real estate and it's residential real estate, like a home, you're typically going through a broker and an agent that actually hands their license at their brokerage, right? And if you buy that home and there's some type of problem that wasn't disclosed, you're going to sue the agent and the broker potentially, right? And the broker's probably got insurance to cover the agent, right? So there's someone you can go after who's responsible and who actually has the proper licensing and the proper insurance. That's how they're a broker. They have to have all these things. Now, in ATM land, it's actually somewhat similar. You can have a large ATM company be something called an IAD, which is an independent ATM deployer, or an ISO, which is an independent sales organization. They're kind of used, the old term was ISO, the new term is IAD, the industry switched it. So if you either of those, they're kind of interchangeable from my understanding. So any IAD or ISO is actually sponsored, audited, and supervised by a bank. You cannot become an IAD or ISO unless you're actually under those three categories. Now, what's also interesting, so consider that the broker, right? In the example of the residential example on the real estate side. Now, what's also interesting is that if you want to operate ATMs and get connected to the network, you either have to be this IAD ISO or you have to be underneath an IAD ISO, technically supervised, but it's very loose, right? So of course, if you're going to become a Ponzi scheme, are you going to choose to just be under an IAD and ISO and just operate very freely? Or are you going to actually be sponsored, audited, and supervised on an ongoing basis by a bank? Of course, the Ponzi schemes are not going to be IAD or ISOs because it's way too complicated. They don't need to be audited by anybody or supervised by anybody. And of course, that's just the option to go with. So I'm invested with a second operator who happens to be an IAD or ISO. It's very rare to find, but when you find one, you're starting off by reducing your risk of a Ponzi scheme because they are literally, in order to continue to operate as an IAD or ISO in good standing, they were literally sponsored, audited, and supervised by a bank on an ongoing basis, right? So that's a very good starting point if you can find an operator that has that certification. Again, I would expect most won't, but I just want to point it out to people as part of due diligence because you're starting from a lower risk perspective, never zero risk for sure. Anybody can become Ponzi scheme at any time if they choose to, right? But certainly reduces your risk. Now, another thing you could do is if someone is an IAD or ISO, they also are going to be connected directly with a processing company like Visa, and they're going to be, they're basically only the IAD or ISOs can get connected as a processor through Visa, MasterCard, etc. So if you want to verify that someone's an IAD or ISO, then you basically will go on and check on the Visa website, for example, just type in the company's name, what's their status, and it's actually all there and it's very transparent. So that's another second check that's kind of nice. Now, I will say my understanding is that they have to be an IAD or ISO to be a processor. I can't guarantee it. So you're going to have to research this more. Again, I'm not an advisor or whatever on this call. I'm just sharing my understanding here. So I apologize if anything turns out to be inaccurate. So that's the quick overview on ATMs. I know we're probably gonna have a lot of questions. We wanted to keep the slides quite light because Dennis and I are frankly both very big fans of Q&A because we know those are gonna be the most relevant questions for you. As Dennis mentioned before, if you ever want to reach out to me for any reason, I'm in over 60 LLCs right now. I invest across a slew of things. I'm just gonna rattle them off very quickly. I'm currently in apartments, student housing apartments, mobile home parks, self-storage, RV parks, office, retail, industrial, single family holds, flips, hard money lending for single family, ATMs, and a host of other non-real estate stuff. So if anyone's either new and just wants to have some questions for someone who's been doing this for 20 years, if you're experienced, you want to network with another investor. If you're an investor, I have my own investor group. So if someone has an investor group and they want to network, anyone's welcome to reach out to me, as Dennis mentioned. Easiest way is that email address on your screen, jroll@rollinvestments.com. So I'm going to hand it back to Dennis for next steps here in Q&A.
Thank you, Jeremy, so much. That was awesome. I still like, even though that due diligence checklist is actually in my book, still when you go over, it just makes so much sense. And yeah, so thank you, Jeremy. I did want to ask you a couple of questions myself on that due diligence checklist. And I think we went over this before, but I'm sure this might be a question on someone's mind. And by the way, if anybody has a question, please throw it in the Q&A or the chat, doesn't matter which one, and I'll get that to Jeremy right away. So in terms of the terminal login, right, there's a big operator out there that you're familiar with, and a lot of the big capital raisers, they raise for them in one shape or form. They just kind of put their brand on it. But if you're an individual investor and you're going in for the minimum, which the minimum for ATMs is usually around 52,000, do you see any friction with contacting the operator and asking for that terminal login, being a minimum investor? I'll let you answer that.
Yeah, so let's go over the terminal login once more. It's very important to understand. Technically speaking, any operator can provide a login for someone else's guest. As an individual investor, you're almost never going to get that from a large fund because they're literally giving you all their locations. And if you're their competitor, you literally now have the entire list of locations they have, and you can go and try and go after all those locations to get them to switch to you. So it's very proprietary. So you're almost always not going to get that. What you can do, though, is meet with the operator in person at their office and say, okay, let me see your machines on your screen just so I can validate that they're real and you really have them. They're actually active and operating machines, so I know what percentage of your machines are up or down and how you're managing them, right? That to me is the better solution. Now, as an individual investor, are you going to get access to a huge operator to be able to do that? Probably not if you're investing 50,000. I'm just going to be honest. But can you ask the group you're investing with if they did that and what the results were of what they found? Of course, right? So part of the challenge with the ATM operator you're talking about, Dennis, is that most people are investing, actually some are investing directly with the operator and some are investing through groups. And when you're investing through a group, you're going through an intermediary, and therefore, you may not have direct access to the operator, but you should be able to get some questions answered to the group. So I just want to point something else out that I didn't mention that's very important. One of the ways that these Ponzi schemes get perpetuated in ATMs is that the operator is actually legitimate at first, but then starts getting a ton of investor money thrown at them. And rather than saying, I don't have allocation for you right now, right, they'll take the money. And especially if it's an individual ATM you're getting attached to, imagine like I invest in a machine and it's in a certain location. It's in a liquor store in Philadelphia, okay? And then Dennis wants to invest and they actually show him the same machine. And like 20 investors are supposedly getting the same machine, right? Because nobody knows, and there's nobody else attached to it, right? So the one thing that I tend to do to try to minimize that risk is if I'm going to do due diligence, rather than that, in addition to looking at the logins are quite good if you can get them, is just to help minimize the Ponzi scheme risk, I will say, okay, give me, I want to get in a car and go look at machines in my area or in a certain state. You just choose the random state, say, give me your entire list of machines in the state. Or better yet, if you're actually in front of their computer, say, I want to choose the machines I'm going to see. You can't choose them, right? And so it's not the best thing because if I get to Philadelphia and I look, there's actually a machine there, and I don't know that somebody else is being assigned the same machine 10 times, right? But at the same time, if you want to verify that the actual portfolio is real, I'll tell you what I did with the big operator myself, and this is going to sound very extreme, but I felt like I needed to do it. I visited their headquarters, and they were happy to be in Pennsylvania. I literally made them get in the car with me and drive across 5 states. Actually, without them being able to choose the machines in advance, they literally just said, here's an entire list of machines in all the states. And in fact, what was really great is when we got into Manhattan, we drove in, and then they pulled out an iPhone and literally dropped like 1,500 pins on a map. And they said, these are all our machines in Manhattan. Which ones do you want to see? And I just chose 5 random ones. So in other words, if 50% of the portfolio is fake, there's a good chance if I look at enough of them, I'm going to find a fake one, right? But if I get to choose them and they don't get to choose them, then I might find them. If they get to choose all of them, they're going to choose all the real ones. So there's certain things you could do with being very careful. I just want to throw that out because I should have mentioned it before. So anyway, sorry for that long answer.
No, that's great. And DeMarc has a question, but before that, I just wanted to add on to what you said about the physical locations. When I was doing research for the book, one of the Ponzi schemes I found was, this was a New York operator, and he disclosed to his investors that he had something like 3,000 machines operating, and in reality, they only had 300. So if you would have randomly picked one location, you would have had, a 10% chance of stumbling onto an actual physical location. If you would have just done 2 locations, the odds basically are like at basically 1% that you hit 2 actual live. So by just even going to 2 physical locations at random, you cut down your chances of some of these Ponzi schemes, dramatically. And no one ever thinks to do even that type of minimum work.
Yeah, that's a really good point. Yeah. And I hate to say it, but I'm not surprised because it's exactly what I said before. This is someone who had a legitimate business, and then they just were thrown so much money that one day they just went to the dark side, right? And they just started taking money on machines they don't have. And they can piece it together for so long. They could be giving you distribution from someone else's new money. I mean, that's how a Ponzi scheme works, right? As long as they continue to raise money, it all sticks together. But at some point, it catches up with them, unfortunately.
I remember I had multiple conversations with a securities attorney, and their favorite line is that 99% a Ponzi scheme never starts off as a Ponzi scheme.
Yeah.
So that's one of the good lines. So we had a question from Mark. He asked if there's a list of active IEDs or ISOs. I know you briefly mentioned it with the Visa, but maybe you can elaborate a little bit to that.
Yeah, great question. So there is a list of the Visa processing because that's how I verified this other operator, so I know it's out there. I believe there is going to be a list of IEDs or ISOs. If you look it up, I can't tell you where it is or how you're going to find it, but I'd be surprised if there wasn't a list. So that's actually a good point, Mark. You could probably verify somebody. I'll tell you what I did to verify the one that I invested with. I actually got a contact at the bank that sponsors them directly, and I got a letter of good standing from the bank directly saying that they're actually in good standing with them as an ISO and that there's no issues with them or as an IED. So that's what I did.
And I'll also say that Jeremy, one thing he does, and he's very modest with what he does for his investment group, but I'm one of his investors, and every single year before he announces if he's going to do an ATM investment or not, he actually gets an updated certificate of good standing, and he includes that as an attachment. So it's not like it's grandfathered in and then you have the certificate for the next 20 years. It requires recertification. And I love that Jeremy actually does that on a yearly basis.
Yeah, and that's something else I want to mention with background checks, because just because you did a background check on somebody 2 years ago and then you want to invest with them again, it doesn't mean it's going to be okay, right? So I'm not saying if you invest with someone 3 times in 3 months, you have to run the background check every time, but there's an interval in which you need to make a decision that you're comfortable or not comfortable. And so is it 6 months, is it 1 year, whatever it is, because someone's background check could be, everyone's background check is crystal clean when they're 1 year old. So at some point, something happens, right? So just be careful with that too. I constantly rerun background checks on people I'm reinvesting with for the similar reason.
And Jeremy, I always tell my investors that even Bernie Madoff had a clean background check the day before the Ponzi scheme fell apart.
Yeah, so and that's great. And so that's why, like I tell everybody, you can never get rid of the risk fully, right? There's always a risk. Like I tell people that, frankly, to be honest, I can give you 20 different, what I call 1% risks, right? Ponzi scheme is a 1% risk, mismanagement is a 1% risk, some other type of fraud is, and all kinds of other weird stuff, you know? You invest in an apartment building, the entire thing burns down, the insurance company refuses to pay, you have to sue them, wait 4 years, there's a cash call to do that. You're getting no cash flow, you're losing money, and then you lose the case, right? So these are all risks that you have to be comfortable with. And that's why the diversification across all different types of asset classes, geographies, and operators is really key.
Got it. Okay. So Mark had a follow-up question. This is more of a general question, I guess not ATM specific. I'll just read it to you. We're still in our first 6 months as LPs and getting comfortable with the risk profile. What's a reasonable failure rate for investments performing well below, and then I guess follow-up question, performing well below pro forma? So I guess, what is a reasonable failure rate for investments? That's one question. And then for investments that are performing well below pro forma.
Yeah, good question. So my answer to that is that it actually really depends on the type of risk profile that you're targeting. So here's a way I can put it to you. I've never invested in development ever in my 20 years because it's the wrong profile for me. It actually might be the perfect fit for someone else listening to this, but it's just the wrong thing for me. I tell everybody there's 1,000 ways to invest, none of them are wrong. It's whatever's the best fit for you. So I look for predictable cash flow in highly occupied and stabilized type opportunities, right? So when I'm investing in something, let's just take a real estate asset, which is easy, everyone understands it. So, if I'm investing in a 95% occupied apartment building in a really great location in a growing market, and it's, not typically class A or class B, and it's being managed by someone who has a lot of experience and they're doing good job managing it, I like to compare it to, I'm going on a flight and it's a Boeing 737 that's 3 years old, and it's got a ton of redundancy and modern electronics. And truly, like, if it's been maintained properly, 6 dominoes have to fall for you to actually crash, right? It's not normally one thing that happens. It's a series of things. And so odds are I'm going to make it to my destination and be fine. If I get on a Boeing 737 that is 50 years old and has changed hands 4 times, right? And maybe was not maintained perfectly by one of the owners, but doesn't have the same technology and redundancy, only one domino has to fall before it goes wrong, okay? It could be the airframe is old and it's just tired, whatever it is. So my point in telling you this is that I liken the high risk stuff to being that 50-year-old aircraft where one thing can go wrong and you can have a big challenge. And I say that the lower risk stuff is the more modern aircraft where a lot of things have to go wrong. So, if you ask about a failure rate in the stuff that I happen to target because of my profile, because it's highly occupied, stabilized stuff, it's performed for a long time, hopefully with experienced managers, the failure rate's going to be low, right? And I couldn't tell you a percentage. If you're investing in a value add deal that actually has more variability to it, then the failure rate's going to be a little bit higher as far as performing well below pro forma, right? And of course, development, the highest end of the risk, it's all risk reward, right? So I don't have a good answer for you on that exact question. It just varies depending on your risk profile. Can I go to the next question, Dennis? Go on. So Mark, I can't talk about my investor group. I don't like talking about it due to like anti-public solicitation laws with the SEC. I'm just really conservative. Just feel free to contact me directly. I don't even like just mentioning the word investor group beyond talking about my bio on something like this, just because I just don't want anyone ever say I publicly solicited them. So I can't really talk about it, unfortunately, on this venue. Have you come across Verivest for verification? So I have talked to the founders of Verivest. I have never invested in a Verivest deal, so I have very limited feedback on you. I like the concept of what Verivest is doing. I've never done my own due diligence on Verivest to determine exactly what they're doing and whether I think that's extensive enough, and honestly, how often they're doing it. And all this. I just don't know enough about the details with them to give any feedback on them. Unfortunately, I apologize.
Sure. And I'll jump in on a couple of these. We're still in our first 6 months as LP question. I did want to say my first investment of my entire investment career, going back like 20 years, my first investment has always consistently been really bad. My first mutual fund I ever bought was bad. My first stock I ever purchased was bad. My first everything. My first private security was probably bad. What ends up happening is that when you do it all yourself, you tend to make a mistake when you're starting out in areas that you're not familiar with. When you take those 6 months and like you're on this call, you're taking your time out and you're networking on this call and you're asking really good questions, you expedite that learning curve so significantly where your risk reward is going to change dramatically. This is one of the things that I love about private investments versus public. Like I'm a big guy that I love, stocks out there, but I don't like stock picking. And I felt like after 20 years, I didn't become a better stock picker because I've been doing it for 20 years. I just learned to streamline the process and not be emotional during sell-offs. But with private instruments like alternative investments, like ATM funds, like real estate, you literally become a better investor by networking with others, having the conversations. Which operators are you invested with? Joining investment groups, not to mention Jeremy's group or anything like that. But there's a couple of really good investment groups out there. Joining those groups, talking to limited partners, and your learning curve. There's no reason why you have to learn on your own investment. You can learn from a lot of other people's knowledge and their own investments, and you quickly realize which variables don't work for me. Similar to Jeremy, I don't do developmental deals as well, because if I was gonna invest for appreciation, I would probably just stay with stocks. What I look for with private securities is that predictable cash flow and that capital preservation that you get from it being illiquid. So those are the things that I wanted to also kind of chime in a little bit, that even though you're 6 months as an LP, just understand your learning curve will be much better after a year or two doing this. So if you can, try not to deploy all your capital while starting out, because these investments tend to be high capital investments. So if you could kind of dollar cost average them, where every couple of months you're making one investment, in the next 3 months, you'll be much more educated than you are today. And then in 6 months, you'll probably be double educated. So it'll probably be better for you to deploy capital towards the end, towards, the future versus today, but don't be scared of actually investing today.
Yeah, can I just add a couple things to that too, for someone who's new? Is that okay?
Yeah, go ahead.
So two things, just I like to tell people who are new and just considering what to do with this whole entire investing space. One is be sure that you've taken enough time to derive your own opinion about where we are cyclically before you invest in any of these types of opportunities, most of which have assets involved or require some type of cash flow from ongoing business. And what I'm saying that because real estate cyclical, the economy cyclical, consumer using ATMs, is more active, in an upturn versus downturn example. So every opportunity can be impacted positively or negatively by depending on where you are in the cycle. And I think a lot of people who are new that I talk to haven't necessarily taken the time to think about that. They just kind of show up one day and say, okay, now I have money to invest in the space and I'm thinking about it, but they don't take a step back and say, is this the right time to invest from a cyclical or economic perspective? It's the right time for you to invest because you have the cash, but that doesn't necessarily mean it's the right time to invest in the cyclical. But I'm specifically mentioning this, we're recording this in April 2022. Literally today, Q1 GDP first preliminary estimate came out negative 1.4%. Everyone was very surprised, right, that it was negative. There's a lot going on right now with interest rates increasing, inflation, where basically the definition of stagflation is a stagnant economy with inflation. That is truly exactly what's happening right now in Q1. Stagflation, inflation, negative economy, right? So be very careful right now and just make sure that you formulate your own opinion about where we are cyclically before you go into anything. So that's number one. Number two is if you're brand new and you don't know what to do as far as what to invest in, et cetera, my number one suggestion is always to focus on one asset class first, especially we're talking about real estate. I would recommend focusing on the asset class you understand best. So a lot of people understand apartments because they lived in apartments before, so they get the business model. It's also not such a complicated business model. But honestly, if you grew up in a mobile home park, I would tell you to do that one first because you're going to understand that best, right? So argument's sake, call it apartments. Then go learn as much you can about apartments, look at some opportunities as samples, get whatever education you can, try a couple of deals in apartments. And then eventually when you learn enough about them, you'll find that like 80% of what you learn is transferable to the next asset class, like mobile home parks, because they all have revenues, they all have expenses, they all have a net operating income. Most of them have loans attached to them at a certain loan to value, and they're all somewhat similar. But there are some variations you have to learn across the asset classes. So I would tell someone to focus on one asset class first, get comfortable, learn, and then transfer that knowledge into a second or third one over time. So anyway, sorry, Dennis, just another thought about if someone's new.
No, that was absolutely great advice. And you tend to, with alternative investments, you tend to actually have a little bit of a case of the shiny object syndrome. And I think that's a great way to fight it, is by learning competence in one of the asset classes. And like Jeremy said, one of the reasons people always said, like, oh, you wrote a book about 9 different alternative investments. I said, yeah, but you'll be surprised as you read the book to see the synergies, to see that the language, the terminology, it all repeats itself. Once you learn what a cap rate is and what NOI is and all of that stuff, it's not going to change just because it's a mobile home park versus a self-storage. Yeah, there's nuances to learn, but it's much easier to learn nuances once you got the broad, language down pat. So that's just such great advice.
Good stuff. So I think we have, what, about 10 more minutes. Did we get another question here?
Yeah, Mark just came in. Mark, really great questions. Thank you for keeping them coming. Jeremy, is there a national conference you'd recommend to meet other LPs in person?
Yeah.
I have a feeling I know which one you're going to mention.
Yeah.
We'll get to that, and then I'll ask you the second part.
Okay. So there are a lot of national conferences now. I'm a big fan of those conferences in that if you go to one with the big critical mass, you'll meet a lot of people, get a lot of very efficient networking done, and also learn a lot from the panelists and speakers. So the first answer I'd have for you is it really depends on whether you're trying to learn one asset class or not. So if you want to learn apartments and you're brand new, you can actually go to national conference dedicated to apartments. And if that's the case, honestly, there's a conference coming up in late June, that is called MFIN, run by Dan Hanford, passiveinvesting.com. I've never invested with him, but he's been running a conference virtually actually since way before COVID, just as he's leveraging Zoom. And he used to get like 1,000 people attending this conference. I've actually been a panelist on it a number of times. So he is having his first in-person conference, and knowing Dan, he's going to end up with a lot of people there. And he's probably going to have some good speakers. He gets a lot of very high quality speakers at his on his Zooms, so on these virtual conferences. So that's the first time they're launching, and I think it's in Charlotte, but it's going to be a large critical mass, for example. I can't vouch for it, and I haven't been there, but I'm pretty sure it's probably going to be pretty good. I'm actually going to be there, but it's only because I'm a panelist there. My favorite overall conference of the year, because of the size, is always my recommendation of the best ever conference, which has taken place until this year in February in Denver. Next year, it's going to be in Salt Lake City. It occurs in February every year. And I've actually been there each year since it started. I always found a very high quality turnout of people. They have a very good mix of asset classes and really good speakers. I know Ben very well now, who organizes the conference along with Joe, and they're very picky with their speakers, very, very picky with their content. And to give you an idea, there were 1,200 people who were there in February this year in 2022 in Denver. So they get a huge critical mass. So that's the number one I'd recommend. If you can only go to one a year and you want to spend the money on one, just because of size and also quality of content, I recommend that. I'm going to plug a conference I actually founded myself or co-founded, which we've had in LA each year, called the IIREC, Intelligent Investors Real Estate Conference. I don't recommend that first because we don't have the same critical mass. We had about 300 and some odd people paid at our conference in January here in Los Angeles, and it's always nice to go to January, to LA in January with the weather. But we're very careful with our content, etc. I don't want to pitch you our conference. I think it's more important you maybe look for the largest critical mass conference if you're only going to go to one conference, for example. And there's others too. There's other good ones too we could talk about.
Yeah, and Mark, also take a look whenever you see a conference and you might be interested in actually attending. Take a look at who the keynote speakers are, because that's going to dictate the quality of the actual conference. Because, like, for example, if you're going to go to Bigger Pockets conference, that's going to be a lot about flipping and wholesaling. And if you're looking to be a passive investor, that might not be the right place for you, even though it might be a great conference. Versus if you go Best Ever and the lineup is 12 different operators, and that's exactly what you're looking for, that would really check off more of the boxes for you. So also throw that out there, is just to make sure you see who the actual keynote speakers are, because that's usually going to dictate the type of investors it attracts.
Yes, and yes, that's a very good point, Dennis. Let me just get down, because we're running out of time here, down to the next question by Mark, which is, what I recommend for ATM background checks, if you cannot qualify to use TLO or Actor, and it's very strict as to who can qualify. You have the real company, you have the real office, you have to have locks on your doors in certain ways. It's very complicated. But what I'd recommend instead is hiring a private investigator who has access to one of these two databases and who's experienced. And that's actually how I started doing them myself until I got access to these databases. Essentially what they do is they sign up the TLO or Accurant and they run the checks for you. Now, they also have the advantage of probably being in business for years and being able to interpret those background checks better than I can, and maybe digging into certain things in a little more in depth than maybe I know to. But that's my suggestion for a backup, is to find a local private investigator, hopefully someone who's experienced, that has access to one of these two databases to get information.
And Mark, just to piggyback on that, you could also, if you invested through an investment club or investment group, a lot of times one of the founders or the operators would have already run those background checks, so they could send that to you if you, I guess, invest through the club or the group. The other thing is, a lot of the operators that are currently out there, they are branding a specific operator out there. Most of the time, the capital raisers themselves would have done a background check as well. So that's something you should probably just, get to and ask them as well. So it's not always on you, but again, there's a certain level of confidence you get when you actually do it yourself, and it's definitely great practice to do it for the long term.
So we have time, I think, we have about 5 minutes left if anyone else has any questions. I don't know if Dennis, there's anything you want to close with as well, but I'm happy to take more questions.
No, I think that was great. I think that was the perfect purposes to get past, because a lot of times you'll see the ATM webinars and they'll tell you about the great returns and they'll tell you about the great cash flow. And they tend to skip over the fact that this industry does have a lot of Ponzi schemes. So the purpose of this webinar was to really highlight that and not go over the great returns and the great cash flow that these ATM funds can provide.
Yeah, and keep in mind, everybody, that do your best on your due diligence, but in reality, you always have to be comfortable with the 1% risk across all different possibilities. And like we've talked about here, someone may not be a Ponzi scheme and turn into a Ponzi scheme. And of course, all you can do as an investor is the following: do the most due diligence you can, the best you can up front, and be very diversified across things. So if there is a Ponzi scheme, I always say what Bernie Madoff did was obviously horrible, and a lot of people lost their entire fortune. But had those people diversified, they would have had a really bad event, but it wouldn't have taken them completely down. So the diversification is absolutely key.
No, that's great. I think that's basically it. I'm really fortunate. Thank you, Jeremy, for coordinating this with me. I can't stress enough, if you guys want to reach out to Jeremy literally responds. He's one of the most responsive people out there. So jroll@rollinvestments.com. If you want to learn more about my group, that's SIHcapitalgroup.com. If you go on the website, click learn more, you'll get the free bridge version of my book. If you go on Amazon, you get the full version. That's the Alternative Investment Almanac Expert Insights on Building Personal Wealth in Non-Traditional Ways. And that's basically it, Jeremy. We wrapped up with 3 minutes to spare. So thank you so much. And I will send you out a recording of this when we're all said and done.
Good stuff. Thanks again for having me on, Dennis. Hope this is helpful for everybody who attended. Thank you for joining us.
You got it, Jeremy. Take care.